Happy Saturday and welcome to the Saturday stock stream. In this stream, I'm going to be doing some research on some stocks, seeing if these stocks are currently discounted, if we compare the value of these businesses compared to its current stock price. The value of the business is driven in my book by looking at free cash flows, forecasting free cash flows in the future, and then trying to drive to an intrinsic value, a net present value of those cash flows in today's market, and then comparing it to its stock price. I'm also going to look at earnings per share and comparing the intrinsic value of a stock, looking at earnings per share in a forecast, and then comparing that to the stock price that the stock is trading. And I'm going to be doing a working session. So if you're interested in going through the step-by-steps on doing so, you came to the right live stream. I'm going to be pretty much doing that from start to finish on 3 stocks that I come to the stream intending on doing. And then if you'd like me to look at a stock and you're a member, just put it in the chat. I'd be happy to look at it. If you're not a member, you could pay a $5 super chat. I'll take a look at your stock. Or you can become a member on the fly. And you can look at different options of memberships. Be happy to take your requests there. So let's get into it. We've had a kind of a mixed week this past week, and some stocks went up, some went down. It wasn't entirely clear, which sectors were on their way higher and versus lower. Perfect example of that point is you had NVIDIA going down while Broadcom was going up, and they're both semiconductor stocks. So you would think they're going to go in the same direction together, but that wasn't the case. And financials went down substantially. Amazon went down. Energy went down, but there was some green to be had. You've got Google was going up. Google's had a nice month. They're up more than 20% in 1 month. Big Google. They've had a couple good stories go their way. The Department of Justice is not going to make them sell off Chrome. That was good news. And in other places, stocks were doing well. Salesforce, their stocks sold off after they announced earnings. And then the following day, they went up almost 3%. So that was good to see because I think Salesforce is a good stock. So there was some green and there was some red. When we look at maybe just going away a little bit, let's go the 1 week heat map. And you see that over the past week, NVIDIA went down 4%. And this is post their earnings. So that was interesting. And then we have Broadcom went up substantially over the past week. Google went up substantially over the past week. These are big cap stocks. Apple went up. Netflix was up nice. Amazon was up overall. Tesla was up nice, 5% higher. And Home Depot is up about 3%. Walmart is up 3.64%. But financials for the week were down. Energy was down. So the big oil companies were down. Healthcare was mostly green, a couple reds, but United Healthcare was up. AbbVie was up. That looked pretty decent. Going away a little further, and if we look at the 1 month, over the past month, look at that. Google, 20.49. Nicely done, Google. Apple as well. Look at that, 17.87. I think the decision with the Department of Justice not breaking up Google also helped Apple because Google pays Apple something like $20 or $25 billion a year in order for Google to be the default browser on Apple's devices. They also pay Samsung something like $2 or $3 billion per year. So those payments are going to continue. They're not going to be disrupted by the Department of Justice. And that was good news for Apple. Amazon was up nice, 9.77. That looks really good. Berkshire was up nicely over the past month. This is the heat map for the month. Look at United Healthcare up 30.88%. That's a move in the right direction. Home Depot is up 10%. Tesla was up 13%. So there's some really good performing stocks. Going in the opposite direction, AMD down 14.5%. And Micron was up 21.9. Intel was up 25. Qualcomm was up 8. ADI, I'm not sure. Is that advanced? I don't know what that symbol, what the company name is behind that symbol. Intuit was down 14%. Interesting. That's a really good software business. So the market is expensive, but there's still some good stocks that are continuing to go higher. And we'll see how we make out in this month of September. September could be a month where we have some pretty good sell-offs. And we've got, the first week in the books wasn't too bad. I think overall the stocks in general went up slightly, some better than others. So we'll see. We've got 3.5 weeks to go and a lot of trading left. Okay, so I am going to get into a little bit of a working session. I welcome you to join me. We're going to get into some stocks and fully analyze these companies. We're going to start with Innodata Incorporated. This is a request from a member. He brought this up on a stream. It looked really good. And I wanted to analyze this stock. And I want to take you step by step on every step of the way. Innodata operates as a data engineering company in the United States, the United Kingdom, Netherlands, Canada, internationally. This company operates through 3 segments: digital data solutions, Synodex, and agility. Okay, so they deal with data, and they're right in the heart of AI data preparation services, which is big right now. They're classified as a technology company and technology services. Okay, so that looks good. And I am going to put this message up so everybody knows. We are analyzing these 3 stocks. I welcome you to put in a request. If you're a member, it's included with your membership. If you're not, $5 super chat, and I'll do the same analysis that you're seeing on Innodata. All right, so Innodata looks like market cap is $1.38 billion and revenue of $228 million. Net income, $42 million of net income. P ratio is 33.95 and forward P is 52.9. It's a strong buy according to analysts, and the stock is discounted by 32%. Over the 1 month, it's down. Year to date, it's up about 10%. So it's right there with the S&P. The 1 year looks great, 181%, then 2,000% over the 5 years. So these guys, wow, they were really discounted a couple years back. So that looks really good. Taking a look at their financials, this is their income statement. Their growth is really exciting, 112%. That looks really, really exciting. So we have the latest quarter that ended June 30th, 2025. They grew by 79%. If you compare that quarter to the year prior, these are really good growth numbers. Excellent growth numbers. All right. I like looking at gross margins to see what kind of business we're dealing with. So this is 42% gross margins. What that tells me is they're not as profitable as a software company. They are having to pay people to do a lot of this services, a lot of the services they're providing. So it's not going to be as profitable as, let's say, a Microsoft or a big software player that provides a platform and it's just a very profitable model. That's not the case here. So it looks good, but that is a limitation that I'll note that, hey, it's not a high margin business. The free cash flow, $36 million. Okay. So I'm going to make myself some notes. So 36 million in free cash flow for the trailing 12 months. And I like looking at the balance sheet of every business just to make sure we don't have too much debt. And if we have too much debt, it could really ruin a good business. 59.79 million and only $4 million of debt. That looks really good. So 59 and 4.22 of debt. Looks good. And the debt to EBITDA should be really low. Debt to EBITDA 0.1. So no debt. No debt at all. Free cash flow. We have 4 analysts covering the stock. Not a lot of coverage. It's a small company. And one analyst believes it's a $75 price target stock. Another analyst is on the other end of that. On average, these analysts are saying, hey, it's discounted by 32%. When we look at the growth rates that analysts expect, 7 analysts are weighing in on the forecast, and consensus is that they'll grow this year by 48%. Seems like they're growing faster than that. And next year they'll grow by 21% and then 4%. Now this is a kind of a dramatic slowdown. And it might be that, hey, they're helping with the AI build out, but what's going to happen if things slow down? These guys, their growth rate isn't going to last a long time. So that is a limitation to their value. Okay. One thing to note. That's why I look at these growth rates. Are they going to sustain that growth? All right. So this year, their profits are actually dipping a little bit, and then they're going to increase next year. All right. So I'm going to use earnings per share for next year, since we're already well past the midway point of the year. Okay, so I've got, I think, the details I need. I need one more number, and then we're going to jump into a valuation. We're going to value this stock based on free cash flows and earnings per share. The shares outstanding are 31,000,085. All right. So that looks good. All right, let's take a look at valuation. And it looks like a question came up. What do you think about Intuitive Surgical? I think it's still too expensive. I'm not sure. I'd be happy to take a look at that. I could do a full analysis. I do have Intuitive Surgical already valued and researched. Just put in a $5 super chat or become a member, and I can get into Intuitive Surgical. Thanks for attending. Appreciate it. Okay, so we are to the point where I want to value symbol INOD. So this is my valuation model that I've created. I'm going to make a little bit of room here and just copy one and use it as a template, and then value this stock that we are researching. So let me make some room here, and then we'll pop it in there. All right, today is the 6th of September. We are good there. So the balance sheet was really good. So I'm going to leave the discount rate at 8. And the symbol was INOD. And it's Innodata. Trailing 12 months cash flow was 36 million. That is 36 million. Now, what would be the growth rate? Now, for a couple of years, it's expected to grow quite a bit, like next year growing by 25%, but then slowing down. So I don't want to get too ahead of myself on that. So I'm going to grow it by 10%. But the first year, I am going to grow by, let's call it 40%. All right. So that drives an intrinsic value of, yeah, and that's good there. The terminal growth rate is what I was looking at, and that should be fine. So the intrinsic value of all these cash flows is $1,790,000,000. Okay. And that's discounted by 8%. So it's taking into account this forecast and then terminal value, all cash flows beyond year 4. All right. How much cash did we have on that balance sheet? So the cash on hand was $59 million, and we've got $4 million of debt. No big deal. We have how many shares outstanding? 31 million shares outstanding. So if we compare the current stock price and compare it to the value of the cash flows, the stock is discounted by 25%. The value of the stock is almost $58, where each stock is being sold for $43.48. So 25% discount there. Now let's take a look at earnings per share. And Sebastian, I see your comment. Let me finish my stream of thought. Then I'm going to focus on your comment, sir. $1.08. This is a growth stock, but it's going to stop growing. 36. I don't know about 36. I'm going to go 25. And the growth rate, again, it's supposed to stop growing, or this company is going to stop growing in about a year and a half. So I don't want to get carried away on the growth rate of that. Earnings per share, maybe I'll go 15%, and that's it. So combined, Innodata, I like to combine these two numbers, and I put more weight in the cash flow method because I believe that's the principal way of valuing a business. Is the true value of the business is how much cash it's going to drive. But I like to combine earnings per share, which is also a good factor. So I take 2/3 weight of the cash flow method and then 1/3 of earnings per share. When I combine the two, I get an 11% discount. Now, Innodata is a small business, and it's certainly gone up a lot. It was in the right place at the right time, where companies do need data services. But you saw that their margins were right around 40%. That's not great. Like NVIDIA's 75%. Businesses like Meta are 85%. So those businesses are really desirable because they make so much money. Innodata is not a highly desirable company based on their margins. So keep that in mind. The revenue growth looks really exciting, but let's make sure we understand what kind of business are we buying. We're buying a business that has lower margins. So Innodata is very interesting. It'd be an interesting stock for me to watch, but I'm not ready to think about buying this stock just yet. So I'm going to put it on my watch list, and I will just keep it around. I'm going to save this to the valuation repository that I share with members. And then this member will have access to my research so he can take a look at the valuation of Innodata. So that is Innodata. And I thank that member for asking about that. Now let me focus on Sebastian. How are you, Sebastian? You want to look at Build a Bear stock. Okay. That's a company, right? I think is it the teddy bear company? Like you get to build your teddy bear? So, yeah, I remember this because you kind of pick your bear and then they stuff it and so forth, right? St. Louis, Missouri. So here we go. That's pretty cool. So they got a variety of things, huh? Hey, look, even little animals for the football season. All right, cool. And you got stuff for Halloween. All right. It looks pretty cool. This looks pretty neat. I might think about this for a gift for my wife. What's the next occasion that's coming up? So good stuff. Look at that. Good stuff. Yeah. This looks great. Okay. So I got it. So they're e-commerce. You go online, you can get, different types of gifts. And I would say that these gifts are cool. These are, a little different, not the stuff you're going to find at Walmart or Target. You can kind of get a little more creative and be a little more thoughtful in your gift giving. All right, I'm in. Now, this is e-commerce. Good. It's better than retail. I hate bad mouthing industries, but I do not like retail. So let's take a look at this guy. Okay, so we know that this is let me look at one more thing. This is going to be a consumer discretionary specialty retail. And I'm going to agree with consumer discretionary, but I don't agree with this specialty retail. I think it's more e-commerce because you're doing business with them online. So that's okay. Not a big difference in interpretation there. Really small cap, $841 million. Year to date, this thing's up 40%, 1 year, 92%. Man, teddy bears are profitable. Look at that. All right, let's keep going. So revenue, 522 million. That's not bad because you're paying less than 2 times revenue for the business. Net income, 59 million. Okay. PE ratio 14, forward P of 15, very rational. They paid dividend, 1.36. Analysts think it's fairly priced. Now, it has been going up, and not too long ago, along with a lot of businesses, this was trading for about half of their stock price. How is that they're only up 40%? Anyway, so it's really done well since May. All right, so the revenue growth is not exciting. It's let's look at the quarterly. Quarterly looks good. Last 2 quarters, they grew by more than 11%. That is good. So they're doing something right because they keep growing year after year. Now, they're not setting any records here, but it's still growth. Looks good. So their cost of revenue isn't very high. These guys are going to have a higher margin than that technology services business we just looked at. Their gross margins are 56% to make little teddy bears and stuffed animals for people. Innodata is like handling data and probably hiring really expensive database administrators and so forth. And they don't make that good of margins as compared to Build-A-Bear. So Build-A-Bear is at 56. That's very good margins. We looked at Lululemon just yesterday, or maybe the day before, and they had margins in this neighborhood. So good margins. Profit margins, 11%. That's decent. Their free cash flow, they're not showing anything for the trailing 12 months. They have cash flowed every year. Okay. Now, what's interesting is the cash flow did come down a bit. And they don't have a lot of cash flow, but the cash flow did come down. Maybe they're growing their materials. You know what it might be is they probably import a lot of their materials that, like the stuffing and the actual little animals are probably being made in China. They get shipped to the US unstuffed, and then they probably stuff and stitch them, final stitching as the customer orders them. So if the tariffs affected Build-A-Bear, that those tariffs may be squeezing out some of that profit and cash away from this business. That's a theory that I'm creating on the fly. So that might be the case there. So I'll go with free cash flow of, I'm going to average the last 2 years, 46 and 28 is going to be 74. And that means that when I divide by 2, I'm going to get $37 million when I average the last 2 years. That's what I'll go with on the free cash flow forecast. So gross margins were good. All right. I want to check out their debt. Let's see if they have debt. So total debt is 107 million, cash on hand 39 million. So they have 68 million dollars of net debt. I don't know if that's a ton. I don't think it is. I think their size, I think that's okay. So 39.11 in cash and then 107 million dollars in debt. When we go to debt to EBITDA, 0.75. If it's under 3, that means it's a good balance sheet. If it's over 3, it's a risky balance sheet. And we are in the low risk, range of this particular balance sheet. 5 analysts cover Build-A-Bear. One analyst believes it's an $85 price target stock, and one analyst is way down here at 39. On average, or consensus, is that it's discounted just a little bit by 3%. So you have a fiscal year that ends February 1st. That's typical of retail or e-tail. And they are in the year that's going to end February 1, 2026. They're expecting to continue to grow. That looks good. It's good to see a business grow year after year. And these guys are growing year after year. They're not setting any records, but it's good to see the growth. And the earnings per share is expanding year after year. So that looks good. I'm going to use the $4.22, which is next year's, because we're already well into the current year. And when we do these forecasts, we're assuming we're starting today and looking forward 12 months. So if I do that, I go into the new fiscal year by a very good amount. So I'd rather use next year's and look forward. The earnings per share is growing a little bit, and then it's going to grow more in fiscal year 28. And then the year following, it's going to grow nicely. So I'll grow it by about 10%. Let's take a look at how many shares are outstanding. And they have 13 million shares outstanding. All right, so let's go back to my valuation schedule. Make a little more room here, and we will put Build-A-Bear in here. So Build-A-Bear is small. They have a decent balance sheet, but they are really small. So I'm going to go with the 9% discount rate. The free cash flow that I wanted to go with was the average of the last 2 years. That is $37 million. And they are growing mid-single digits. So I'll go 7% on the first 4 years and then 4% on long-term growth. That gives us an intrinsic value of $745 million. Now let me add cash and take away debt. The cash balance was 39 million, and the debt on the balance sheet was 107. So that brings that number down to 677. Shares outstanding were 13 million shares outstanding. So based on cash, on a starting point, which was an average of the last 2 years, if I forecasted using that as a starting point, I'm not seeing a discount. I'm actually seeing that the stock price is 20% too high compared to cash flows or the value of cash. The earnings per share was $4.22. And the PE ratio, this is not a glamorous, really sought after industry. So they are growing a little bit. So I'm going to go with a 16 PE with a growth rate of 10%. So in general, this stock is being sold at a slight premium of 8%. Now that's not kind of out of the question because it's been going up in value. For year to date, it's up 40%, 1 year 92. I mean, at some point, this stock is, got expensive or is fairly priced, but it's not like it's been sold off and wow, it's highly discounted. No, I think it's priced a little bit at a premium, and I'm not sure this is going to keep working. I don't see why not, but it's not like there's a big story or theme behind the success at Build-A-Bear. I think they put out a nice product. Looking at their website, looks really neat, but it's not a stock that's offering the investor a big discount. It's actually saying, hey, investor, if you'd like to invest in this company, you'll have to pay 8% above the intrinsic value of the cash flows and the earnings per share. Sebastian, thanks so much for being a member. And I hope you found my research interesting. This will be posted on the member repository. I'll be updating that probably next weekend. In the meantime, just let me know if you have more questions on it. Thank you for asking. Looks like Q Tong Nguyen. Yeah, I can get into those stocks if you'd like. If you want to go with a $5 super chat, I can get into XPNU Holdings or become a member. And then you can put in a request on the chat and I can research those stocks for you. Thanks for asking and thanks for attending. Great to have you. All right. So we got through Build-A-Bear. We got through INOD. Let me go back to my list. I wanted to research these stocks here. These were requested by members of the channel. We're on to HOLO. Holo. And what does Holo do? So this is Holo. MicroCloud Hologram provides holographic technology services in the People's Republic of China and internationally. The company operates in two segments, holographic solutions and holographic technology service. Its services include holographic light detection, ranging LiDAR solutions based on the holographic technology, holographic LiDAR point cloud algorithms, architecture design, technical holographic imaging solutions, holographic LiDAR sensor chip design, and holographic vehicle intelligent vision technology to service customers that provide holographic advanced driver assistance systems. So that's, a big thing in cars now is, a lot of self-driving technology where you have, looks like I can't hit their website. It's probably in China, but these companies are providing the technology to help with driver assist, self-driving or, lane assist. So it keeps you in the lane and so forth. And also collision prevention or warning. It'll like press the brakes if it sees an object that you're approaching. Now, this is a really small cap, $64.97 million market cap, US dollars. And the revenue is $44.84 million. Net income, $41 million. Wow. Are these guys just selling like a royalty or just selling the intellectual property? Because it seems that way. Very highly profitable. So they're not making money right now, but the gross margins might be good. So over the year to date, boy, this one sold off. Wow, amazing. So they were a $200 stock and now they're $4.46. Wow. What happened? And they were a $200 stock January 2nd, 2025. And I got like a block on my browser, and I don't like to go through those because I feel like I'm going to pick up some bad stuff. And interesting. So we've got revenue of 321 million. They grew it nicely. These guys do semi-annual reporting. We are dealing, okay, this is the Chinese currency, and I think this is 0.14 is the conversion. All right, so that would be, and let me double check that. Yeah, 0.14 is the Chinese currency to the US dollar conversion. All right. And yeah, David, you you see something new every day. $200 to $4. Woo. All right. Let's see what we're dealing with. Cost of revenue is really high. Okay. I thought it was going to be better than that. So gross profit isn't very good. So they do have some free cash flow. Again, this is in the Chinese currency. So once I convert this is like $7 million. So it's not a lot. Gross margins are 24. This is like the automotive industry. Man, and look at the drop. It looks like they were probably selling their technology before and not necessarily selling a product. And now they don't have any pricing power. They're losing, margin. There's probably more competition in the market. So these numbers kind of scare me away. I'm like, whoa, what happened to the stock price? Why did so many investors leave? Now, they don't have any analysts covering this stock. Let's take a look at the balance sheet, see what's going on with the balance sheet. So they don't have any debt, 8 million, cash of 406 million. And is this in dollars or the Chinese currency? Let's see. So this is US dollar up here. So I think it is US dollars. Okay. Well, the reason I want to ask is I don't think their market cap's that high. Okay, so let's call it 400 million in cash. Okay, something isn't right here because the market cap is well below its cash position. That would be really interesting. What's going on with this stock? So let me double check against a different website and see if it comes up here. So this is MicroCloud, and yep, it really, man, it's been coming down hard. What are the stories that are out there for this? So this is 3 days ago. MicroCloud Hologram reports strong financial growth in 2025 interim. So why is the stock just completely collapsing? I'm not seeing like some big, terrible news. So look at the market cap here. We're at 65 million according to 2 websites, but the cash on the balance sheet was much lower. All right. So we got to get to the bottom of this, because if in fact this is mispriced in a big way, I would love to take advantage of it, but we got to do our homework. We got to do our forensic stock analysis. All right, we're on the investor homepage for this company, MicroCloud. All right, we're good there. I'd like to get to their financials and see what they're reporting. So MicroCloud proposes multi-qubit quantum state sharing scheme. Okay. And this is July 10th. So it's a little dated. Okay. This is the annual meeting. All right. I need to see some financials. Let's see if we've got. So I don't think this is going to get me financials. So they're not providing the financials that correspond to the earnings. So let's go back to Google, which had the press release. Here's tip ranks. Yeah, this one is interesting, but the whole sell-off is making me very, very cautious, right? This doesn't sell off because there's good news. There's something bad going on. So I'd want to make sure I understood it. And usually when stocks go down that low, they don't come back. So they're not giving me financials, so I can't do anything with the stock. Let's see financial reports. So this one was released in April. I think this is for the annual report. They didn't provide one. Now, some companies will, I know in like the UK, they report twice a year, semi-annual. In the US, we're accustomed to 4 times a year. And these guys are just providing their financials for the full year. They are smaller, but they should still crank out some financials. That way investors can take a look at their information. All right, so, all right, here we go. So, all right, great. They broke it down in US dollars for us. So here's the cash they have. At the end of 2024, beginning of 2025, they had basically close to $220 million of cash. Okay. They have a loan of $732,000, not much at all compared to their cash on hand. So they have a lot of cash. So the revenue. So when we compare, here's 22, 23, 24. And although it's a Chinese currency, we could still see what's it trending. So total operating revenues, they went from 488 million. Is that right? Yeah. Down to 203, up to 290. So it's been down and then up. Now the automotive business is really, really competitive. Their cost went down because their volumes went down and then it went up. Okay. They did have a gross profit, but they lost money from operations. A lot of research and development. Okay. So the financials are showing that this business is highly discounted, like greatly discounted. But a stock doesn't sell off the way we're seeing this stock sell off, unless there's something going on, like, what's going on? Like, is there Is there a problem because they're a Chinese company? Is there a problem with them and they're in trouble with their government? Or why is the stock selling off so bad? And there's no story that answers that question. So I wouldn't be able to invest in this stock until I got some answers as to why the stock's selling off so much. I would conclude that it's highly discounted if I believed the numbers and felt like their business was going to keep going and it was going to at some point, start growing again. Yeah, this is going to be a huge winner, but it's a huge risk at this point. I think it's an interesting stock to research and try to get to the bottom of it. Now it's in China. I'm in the US. It's harder for me to get information out of a Chinese company, especially a small one. So that would even further increase my caution just to make sure, hey, I don't want to get, blindsided here. It's already pretty low. But this one here is a risky one. Really interesting. I can understand why this member brought it up. So that is HOLO. Hello. Looks like some more people are on. How you doing, Ben Peoples? So have I gone over MNMD? Yeah, so on the Discord, I'll make a note to email you a new invite and let me know what's going on. If you want to join the Discord for the community, we'll get you set up. So let me note that. And I'll email you. And you want to look at this stock, which is MNMD. So Mind Medicine. So Mind Medicine is up 32%, 1 year up 50%. What do these guys do? Mind Medicine, a clinical stage biopharmaceutical company, develops novel products to treat brain health disorders. The company's lead product candidates include MM120, which is a phase 3 for the treatment of generalized anxiety disorder and attention deficit hyperactivity disorder, and MM402, a R enantiomer of 4 dot. Oh boy. And I am not going to pronounce that word. If you had this word on Scrabble, you would get like a massive score. All right. So these guys are really trying to help people that have a variety of mental disorders, mind disorders. Headquartered in New York. They have 74 employees. Okay. So we kind of get a gist of what they're doing. It's a small cap. As mentioned, it went up nicely year to date, 1 year, 50%. 5 year, looks like they came into the market with a lot of fanfare and then the stock really came down. The 1 year looks promising. So market caps is 701 million. Revenue, no revenue yet. So this is pre-revenue. They have 76 million shares outstanding. So strong buy. It's discounted. Interesting. We'll see how many analysts are covering the stock. So Mind Med. So these are just costs. These are expenses, and their operating expenses 130 million. They're doing research and development, pretty much running the office, that kind of thing. Okay, so I'm going to look at the balance sheet, see how much cash they have, to see how many years they've got of cash left. It seemed like they were in phase 3. I believe that's the final phase to get FDA approval. So they might be a year, 2 years, 3 years away from being able to commercially sell their medicines to the market. So let's take a look at the balance sheet. So the balance sheet has $183 million of cash. They have $41 million of debt. So they have $141 million. And that is like 1 year of their expenses. Here's their operating cash flow, 100 million, right? Negative. So they have 1 year and some months of cash left. Now, if their trials are going well and they gain the confidence of either some investors or bankers, lenders, they could probably get more lent, or they can issue out some shares and create some more cash. If their science is really progressing well and they're getting the right feedback from the FDA. So they have, call it a year and a quarter left of cash, and it seems like their studies are going okay because they're in phase 3. Let's see what these analysts say. 7 analysts cover it. All right, let's take a look at the forecast that they have. That would be interesting to look at. So they're thinking that this company is going to get to their commercial stage. We're here in this year. And I said that they had a year and a quarter left of cash. So get them through this year and get to the end of 2026. So at that point, there is going to be a little bit of a squeeze on cash. They're going to need to figure out how to bridge maybe 6 to 9 months. Then they're going to start getting revenues. Now, it'll be really exciting here because it looks like the revenues, if these analysts are correct, these revenues are going to jump up to 226 million. So they're not going to be profitable there. So 226. If a fourth of that was cash, that'd be 50 million. They grew that. So I'm just trying to, in my head, see if this thing even makes sense to. Yeah, this one is a lot of risk, and it's kind of beyond my knowledge and my, as an investor, I like to operate in my circle of competence. Okay. What are things that I've worked on personally and have really good knowledge from an industry? I've worked in software. I've worked in some pharmaceutical, not this type of pharmaceutical, not this particular line. And then oil and gas and other industries. As I look at this stock, a lot of things are going to need to come together for this one to get to a point of actually selling their product and making money at some point. So it would be a pass for me because it's just too much risk. It's like, you know what? Maybe I check in on this stock in a year. They're still like 2 years away from actually earning $1 of revenue. Yeah, they're about 2 years away. So maybe check in about a year from now. I might be interested. For a different type of investor, I'm trying to look for a cash forecast. I can't create one. I'd just be guessing on this one. An earnings per share forecast, ditto. I'd just be guessing. So I can't get you anything with regards to evaluation, but we can research it together. And I would tell you, keep an eye on that cash. Keep an eye on how they're going to get the additional cash they're going to need, because they're going to have a gap there from like toward the end of 26 into 2027. They're going to need more cash. Now they can issue out more shares. The stock is appreciating some. I don't know if shareholders would like that, or they can get somebody to help them. Maybe there's another pharmaceutical company that believes in their science and they would come in and help them out. But it would be a pass for me. I appreciate you asking, and couldn't get to a perfect valuation like I do on a publicly traded company, like one that's had revenues for a while. But I appreciate it. Thank Ben's people, and then I'll look up, see what's going on with Discord. We have been cleaning up Discord, just making sure that only legitimate members are in there, because as you guys might know, Discord has a lot of bad actors, and we just, we're trying to weed them out. So if there's a little confusion there and it took away your access, we'll get it back for you. All right. David Knight, someone in the UK. Thanks for the earlier stream. You're welcome. Angel Lara, how are you doing? Thank you. Thanks for the comment. That's very nice of you to say. So you think INOD is a great opportunity? Cool. All right. Thanks for the comment. Have I checked GAMB? The answer is yes. We've got a valuation on the channel, and I can go through a full valuation on GAM. You're not a member, so a $5 super chat, or become a member on the fly, and then I could review stocks that you request. Gentleman X. So this is it here. An investigation has been launched into securities fraud with the accusations that MicroCloud may have made misleading claims causing a tumble in its stock. That story matches the stock chart. So this story, the story that, Gentleman X is referencing, that is consistent with how the stock would behave. Thanks for putting that out there. All right. So that was MicroCloud. All right. Let's get off that guy. I think you were referencing to that small cap pre-revenue company. Yeah, some investors make money on these, I'm sure, but I think there's a lot of money to be lost as well. If you really know the science, man, knock yourself out. You have an advantage. I don't. So I need to know my limits and don't go past that. I want to make money, and I want to make it in places where I could take logical risks. I like taking risks. I like growth stocks, but I like logical risks. Even with, things like Bitcoin, I've done really well with Bitcoin. I really, researched the overall story on Bitcoin, understood generally that, hey, this is probably going to work for these big reasons, and it worked out nicely. So good luck with that. Thanks for asking. So do I own Zeta? Yes, I do. And here's the second comment. Whoa, no bueno. That is not good for MicroCloud. Sean, thanks for the nice comment. Appreciate it. I haven't received a little trophy in a while. Thank you. All right, guys, let's keep working here. It's a Saturday, but we love stocks so much that, we're going to research a couple more here. We got through HOLO. Now we're going to go to IoT. This is Samsara. And look at that. They went up. They announced their earnings, and the stock has really done well. Now, Samsara provides solutions to connect physical operations data to its connected operations platform in the United States and internationally. The company's connected operations platform includes data platform within which ingest, aggregates, and enriches data from its IoT devices in a growing ecosystem of connected assets and third-party systems, and which has embedded capabilities for AI, workflows, analytics, alerts, API connectors, connection, excuse me, and data security and privacy. Its applications include video-based safety that enables customers to build. So I understand what these guys do, and wanted to read that for you guys. And as you could, I hope, easily imagine, right? We're in a world where we've got sensors all over our cars, tractors, air conditioners, medical equipment. I mean, everywhere you see machines, especially as the machines get more expensive and have maintenance related to them, sensors are on those machines. Now, those sensors are connected to a network and Wi-Fi, and then they report back to the mothership and report data. If you have a sensor reporting, hey, there's something overheating, something is broken, something's malfunctioning, that's information that the mothership wants to know. Or the mothership may just want to see the data to do reporting. Maybe look at usage, efficiency, and so forth. So that's what these guys do. We're currently in the AI era, right? Where you have physical AI and so forth. So these guys should be flourishing because they're in an interesting space that should continue to expand nicely. Now, the stock has had a very good month, but the year to date, look at that. It's down 3.66%. So it's had a very, very, very good rise, but it hasn't had a good 2025. And when we go to 12 months, that's also not as good as the S&P. 5 years, it's pretty decent, but not setting any records. They are a $24 billion market cap company. They have revenues of $1.43 billion. The shares outstanding, and I want to note a few things because we're going to do a full valuation on this guy. And the shares outstanding are 569.34. Forward P is 83.59. Analysts think it's a little discounted and it's a buy. All right. We see that there's good growth in this business. It's a $1.4 billion revenue company growing at 30%. I also like to look at the quarterly just to make sure that it's not dropping, and it's not. In fact, it's really nice and stable. Top line revenue will tell us that a business, the product is desired by the market. More customers are buying it. The existing customers are buying more. This business has pricing power. They could raise their prices and increase revenue. All those things are positive. And this one here is showing me that. So that's a positive. That is a green flag all day, 30% grower. All right. So next I want to look at how profitable are they and how much cash flow do they drive. So the gross margins are really good, almost 77%. Very high gross margins. Now, the profit margin, they're still small, so they're not quite profitable, but they are driving free cash. And look at that. They went from negative to a real nice positive number. That looks like a really good number there. It's probably going to grow very quickly. Now that they are establishing scale, it's probably going to grow at like 30%. Real nice growth rate. Maybe even 40%. So that looks really good. I imagine their balance sheet's going to be good. It's a newer business. Usually younger business don't have a problem with balance sheets. It's the older business that we got to be careful with. They have $701 million of cash. And $77 million of debt. So very good cash position. Really, they don't have any debt because they can pay off that debt immediately with the cash on hand. All right, so we have that. Let's take a look at the forecast. You have 14 analysts covering Samsara, and you have a high price target of $61 and a low price target of $39. All right. So these guys have a fiscal year that ends February 1st. We're in this year right now. The revenue is going to keep growing. Look at that growth. That looks great. They're going to be a good growth company. They're going to be a $3 billion company in fiscal year 29, which is really more like 2028. That looks really good. And they're going to get profitable this year. They're going to stay profitable and grow. So I'm going to use this as my valuation earnings per share, 52 cents. All right, looks good. The reason I came back to this stock is they announced on September 4th, which was on Thursday. I looked at it on the live stream. I go, wow, there's a lot of good numbers here. We should take a closer look. And here we are. All right, so we need to make a little bit of room here. This is going to be the third valuation we do from scratch and try to get a number of what this Samsara business is worth. If we take the cash flows that I expect they're going to produce, a logical forecast of those cash flows, and then we discount those cash flows to today's value using a discount rate. They have a really good balance sheet. We can lower that discount rate to 8. We're going to go trailing 12 months plus growth. The trailing 12 months for Samsara was 169 million 63. In the first year, I'm going to grow that number by 35%. And then years 2, 3, 4, I'm going to grow by 30%. And then long-term growth, I'm going to grow by 5% because the addressable market here is huge. It's really, really big. They should continue to grow. Ben King. You want to look at DraftKings? Let's do it. It's football season. Started on Thursday, man. We got to look at DraftKings. All right, back to Samsara. So we've got cash on hand of $701 million. And they had a little bit of debt, 77 million. The shares outstanding, I think I forgot to collect that number. Let's go back and get it. Shares outstanding, 569 million. Oh, I put it in the wrong field. So the cash that they have, can it grow much faster than this? Yes. Am I willing to grow it faster? No, because boy, I'd really be getting ahead of myself. They are doing very well, but growing your cash by 35% is really, really fast in year one. And maybe I could grow this by 35% there. I'm still underwater on the valuation. The market cap of the business is 24 billion. The equity value of cash flows plus cash minus debt is only 15. So this is not offering me a discount. It's not dangling a beautiful discount in front of me. Let's take a look at earnings per share and see what that looks like. So we have 52 cents per share. This is a high growth business. So we'll go with 36 and then we'll grow that by 20%. Yeah, Samsara is just too expensive. You see that the stock has sold off in the past, right? You've got, this company, the story is good, but you see that it's kind of gotten to certain prices and then it's really folded or collapsed under the weight of that big stock price. And to me, if you look at its all-time high was $59 a share. It's down to 42. I think it's just too expensive. It's gonna have to really grow its cash, show bigger numbers like $1 billion of cash flow before I would say it's worth 25, $30 billion. Right now, that cash flow just doesn't drive enough value. And that's why I do these numbers, these calculations. Is do I think Samsara has a good story? Yeah. But when I look at the test on how much cash they're going to produce, not enough. So that is Samsara. Wanted to cover that one because it looked good, but it's not getting it done for me. All right, let's get into DraftKings. We know what DraftKings does. All right, so we're going to look at DraftKings from top to bottom. Let's get going. DraftKings, let's look at their website. See what the odds are on. Oh, okay. I've seen this commercial on football games. And they have fantasy leagues. They've got their sports book. Okay, cool. And betting is something that people enjoy. They put a bet on the game and then the game, it takes on a new experience. You're really invested in that game, right? And interesting. So that's what DraftKings is all about. Now, I've seen DraftKings in the media quite a bit. And part of it is, there's people concerned, are we going to get out of hand with betting and stuff? Maybe, but maybe not. I think you should let people do what they'd like to do if they do it responsibly. And that's that. So year to date, they're up 25%. You see that they really went up sky high, and then they've come down and have made their way back a little bit. So market cap is 23 billion, revenue of 5.41 billion. So you're paying, call it 4 to 5 times revenue. Not too bad. They have 596 million shares outstanding. Let me note a few things. So 496 million shares outstanding. And their PE none, but next year they're going to be turning a profit. Analysts think they're discounted by 18%. Growth looks good. They've been growing, just growth, just accumulating customers, account holders, and so forth. That looks good. So customers like DraftKings, they come back, they create accounts, they're opening new accounts, they're betting more, they're using more of the fantasy leagues and all that good stuff. All right, so this is their revenue. Their cost of revenue is a little high. Take a look at their margins and their free cash flow. They do have $501 million of free cash. And their margins are not great. 43% is good, but not great. 80% is great. 43 is okay. They're not making money, not a showstopper. They're making cash. That's good. All right. Then we got free cash flow margin of 9.28. Now, if they can just keep growing and growing, these guys can become very valuable because, like, if you look at Costco, they're worth 600 billion and their margins are tiny because of their scale. If DraftKings becomes like massive, they'll become very valuable. Okay, so we got that covered. Let's see if their balance sheet has debt. That is an important step. So not too bad. They have $1,260 million of debt, of cash, and 1,900,000,000 of debt. Okay. Debt to EBITDA shouldn't be that. They're not profitable, so it's not showing a number. But based on their revenue, they're a $5 billion revenue company. I'm not seeing a problem here. This should be just fine. Okay, so balance sheet should be just fine. We've got 24 analysts saying this is what DraftKings is worth. Collectively, consensus is it's discounted by 18%. The the price target high is 61. The low is 48. Okay. It is a little, I feel more confident about price targets when they're all bunched together around a particular range. It seems like they're green on it. So that's good. All right. So let's look at the forecast, and there's going to be more growth. See the number here, the growth. They're supposed to be about 6.5 billion in revenue at the end of 25. And 3 years later, they're going to be over $10 billion. That's good. That's really good. And their profits, look how fast they're going to grow. That looks good. All right. We're looking good. Let's see if those numbers are going to add up and present a nice, juicy discount offer on DraftKings. I'm going to use $1.29, which is the earnings per share for next year. And I'm going to grow it by 45%. I never grow with these numbers because I just like to be conservative. All right. I think I've got the bases covered. DraftKings. All right. So let's go to evaluation. And you know the drill. This is going to be valuation number 4. You guys are going to be experts at valuing companies based on cash flows and earnings per share at some point here. If you like that model, if you become an advanced member, you get a working copy of that model. So consider being a member if you'd like to get your hands on that model. So we're going to look at DraftKings. Their balance sheet was good. Now, I'm going to go 8.5 just because they get a little queasy when we're dealing with gambling. Their balance sheet wasn't perfect. They're losing a little money this year, so no big deal. Just 8.5 there, just to cover my risk. You need to give me odds if I'm going to bet on DraftKings. All right, so what's our cash flow looking like? They're doing $501 million of free cash flow in the current year. They're growing really, really well. So in this one here, I'm going to grow that cash by 30%, and I need to correct that. 1.3. I'm going to grow it by 30%. I'm going to keep growing it by 30%. Their growth rate looks really good. And terminal value, I'm going to lower it to 4%. Okay, that looks good. Cash is $1,260,000,000 and debt $1,910,000,000. Shares outstanding 496. So a small discount available on DraftKings. And this is another way of saying it's fairly priced with a small discount. Let's take a look at earnings per share. So the earnings per share number I'm going to use is 129. It's gross stock, good. And I was going to grow it at 45 because they were going to start growing nicely. So, the way this stock's setting up, right? You have it rising. Man, if we could just get that to $40 a share, it looks a lot better. At $40 a share, then it'd be discounted better, like 20, 25% here and a better discount there. Right now, it's a 16% discount. On a company this size, this isn't compelling to me because 35, 40 would be compelling. And DraftKings is kind of a fun stock. It's neat because I like football, I like sports, I like, the whole culture. But I think a lot of people do as well. There's probably a lot of retail investment because they understand DraftKings. They probably bet on DraftKings, so they're buying the stock. And all that just creates a stock that's priced higher. I want stocks for companies that have great value, great fundamentals, and are discounted. The better the discount, the better. And this one just does not compelling me to be like, hey, this is a really neat opportunity. I can make some money here. Can an investor make some money? Yeah, potentially, or you can lose a little money, but it's not a drastic opportunity in my book. So thanks for sponsoring Ben 10, the review of DraftKings. Appreciate it. Thank you, sir. Please let me know if you have questions on it. I appreciate it. All right, moving along here. So we did 4 valuations. Nathan, what stocks look most attractive to you now? It's a big question. Join my channel. Join the member calls. We have one tomorrow morning, and that's what we talk about. Samuel B1, CEG. So if you're not a member, just like Ben 10 just did, you can buy a $5 super chat. We analyze that company that you're interested in, or you become a member, then you can request it, and that's part of your member perk. And feel free to do that if that's the alternative you'd like to take. All right. And then Max, I think, same for you, sir. So STZ, I can look at that if somebody sponsors it. And Musi, what do I think of Fortinet? I have a lot of thoughts there. Ditto. If you want to buy a $5 super chat, we're in it. Just like we just did DraftKings. So please consider that. Thank you very much for attending. Thanks again to Ben 10 for the sponsorship. All right. So I watch all these stocks. I want to make sure that I provide this all this data to the members on the channel. And I want to make sure that I come back and fill in all this information so people, if they're interested in, hey, what was the valuation of DraftKings? They can come in here and look it up. I'll just remind myself to put DraftKings in there. And I see your comment, Brandon. 1 minute, sir. Just want to remind myself not to forget to come back. And I don't know that I did holo, excuse me. And then there was bear, the bear one. What was the symbol for bear? All right. Those are the notes that I wanted to make myself. Make sure I don't forget anything. Oh, IoT. All right. How you doing, Brandon? Good to see you. SPRY. This is ARS Pharmaceuticals. ARS Pharmaceuticals, a biopharmaceutical company, develops and commercializes treatments for severe allergic reactions. The company is involved in the development of Neffy, a needle-free, low-dose intranasal epinephrine nasal spray for rescue medication for people with type 1 severe allergic reactions, including anaphylaxis. It serves healthcare professionals, patients, caregivers. The company was founded in 2015 in San Diego, California. So get a visual on their product. So this is the Neffy. It's a nasal spray. Okay. All right. So we know what this is. So we did look at this, I think, on a member call. And it's SPRY. Let's see if I have it here. Nope. I don't think we got that far. Okay. All right. So okay, so this is a $995 million market cap company, small, $112 million of revenue. Okay. And losing a little money. Analysts think it's really discounted, that this thing can triple in value. The market isn't totally positive about that. In fact, it went from $18 a share to 10. And it pretty much did that in August. Oof, painful. So we are, and I do remember seeing this, and I remember this caught my attention, right? So when you go to the quarterly, you're seeing revenue pretty much get started, right? You have the company was pre-commercial, and then, okay, hey, we're selling the product. Okay, great. They got a big, gigantic order, and then no order. So you had a big quarter followed by not a big quarter, like $8 million for the whole quarter. And now it's 15 million, but it's way below here. So now that it'd be better, obviously, if we had kind of a nice trajectory of growth, like it went from 10 to 30 to 80 to 120 kind of, but that's not the case here. And this is an area of concern for me because it's like, what's going to happen next? Is it going to go to 50 or 5? I don't know, because I'm not seeing a trend. It's just all over the place here. See the chart. It kind of breaks the chart. It's like, whoa. It's like, doesn't even chart well. So when we see these numbers, it's kind of, we got to dig into them, and you see my point. Now, looking at the trailing 12 months, we've got $112 million in the trailing 12 months, profit of $90 million. So they have good margins. Okay. They don't have any free cash flow. So what's going on here with the cash flow statement? Let's go to their, see if they have their, here we go. So let's grab their financials and try to dig into them, see if we can see what's going on. So this was August 13th. Okay, so this was August, 3 weeks ago when they provided this report. We've got revenues, 15 million. Okay, that's the number that was in stock analysis. This is the first 2 quarters. I guess that big, gigantic quarter was in the fourth quarter of last year. Okay. Okay. And I was looking at the margins, and the margins look good. Cost of goods sold. So this is the statement that I wanted to get my head around. Make this bigger for you guys. Statement of cash flows. Okay. So this is for 6 months, 2025, 2024. So they are losing some money because they're young, they're small, and they don't have big scale. All right. No big deal. No big deal. Let's take a look. So we're starting with a negative starting point, the net loss. Stock-based compensation gets an add back. That's fine. Accounts receivable went up. That means customers owe them money. Inventory went up. I'm okay with inventory going up. You're growing. You got to stock this product in order for the next order to have a decent service level. That way, the next customer says, hey, I'd like to buy your product. Can you get it to me quickly? Yes, got it in inventory. We're good to go. Accounts payable. This means that accounts payable went up. Okay, that's fine. So in general, it's this loss that created the negative cash flow. Let's go back to what's causing that loss. Okay, so is there another statement here? That's the balance sheet. So we got cost of goods sold is here. That's what it costs you to make those little devices that spray, no problem. Then you have R&D, $4 million. Selling. So their office is expensive to run. This is selling, a general, administrative, HR, everybody in the office, $54 million for the 6 months, 95. So this is the overhead of the business. That is a pretty good little chunk there. As they scale up, this should stay somewhat the same, and then they just have higher revenue, higher profits, and so forth. All right. So this business here, this one's a tough one because the revenue is hard to predict. You've got revenue all over the place, right? You got big quarter revenue and then not so much. What are they going to do for these quarters? So let's see if I could so they have negative cash. When are they going to cash flow? Let's take a look at their forecast. So you have 5 analysts. They all think very highly of the company. Let's take a look at their growth. So these analysts believe they're really going to grow. So they're going to go from 85 to 242 next year to 405 to 522. Now that's pretty exciting. So do we believe those growth numbers? Well, not yet. It's exciting. If this is real, I think we got something. So let's go see if we think it's real. So these are the financial statements. That's fine. Now, I would agree, especially if you're going to apply this type of treatment to a little kid. If you showed them this little device, hey, I'm going to spray this in your nose versus I'm going to inject you with this syringe, I think 100 out of 100 kids would be like, I'll take the nasal spray. Thank you. So I can understand people would rather have this. And it seems like it's an easy product to carry around. You know, moms carry like a million things in their purses, and then they could have it should their child have one of these emergencies. Boom, You bring out your Neffy item, and instead of having the pens or the injectables that are currently in market. It's FDA approved. Strong execution. So I'm reading here, guys, and I just wanted to read kind of like what they were doing there. So this is the reaction that kids have. All right. So I'm a believer in their, like, this is a better alternative. They don't have to sell me on that. I'd like to get a sense of how well are you selling your product? Is the market buying it? Because it's one thing for you to have a product that you think is good. It's another for the market to buy it. So that's what I'm trying to understand. This is where they're defining their total addressable market. I believe it's a big addressable market. They're selling in the US. They have manufacturing in China and Australia, or distribution there. Okay, they received FDA approval and filed in Canada, China, Australia, and NZ. What does that mean? Is that Netherlands? No, Australia? I don't. Oh, New Zealand. Sorry, New Zealand. Okay, now we're talking. Now we're getting to the sales forecast. All right, so ongoing. Educate prescribers, facilitate access. So they're going to be doing connected TV and streaming platforms, kind of educate the public. Hey, there's an alternative. If you're a parent and you want to have, or maybe you're a person that has allergic reactions and you want to have a nasal spray alternative versus an injectable, they want to make the public aware that this is available. Okay. Okay. And I imagine not only will parents be buying them, schools will be buying them. Like the school nurses and employers kind of have these. Here's they're going to be promoting, creating impressions over all these streaming platforms. Okay, good plan. So I'm kind of buying into their whole story here. Okay. Now I want to check their balance sheet. Okay. You got a great idea. I agree with your product. Okay. It's probably going to be desirable to the market. Okay. So let's take a look at their balance sheet. We had their financials open. So let's take a look at their balance sheet. What I wanted to see is, okay, you have the cash to fund the deployment of all these campaigns. Okay. So we want to focus on the most recent closed quarter, June 30th, 2025. And these lines, these are the money lines. These are the lines that buy Christmas presents. So $51 million of cash and $188 million of short-term investments, which gets converted into cash very quickly. They have some current liabilities. That's fine. They also have some AR. So I'm not going to look at that. And they don't have any debt. Very good. Wait, financing liability right here. So what is financing liability? Okay, I'll consider that as debt. Okay, so they have roughly $120 million of cash and short-term investments, 120. So when we look at their statement of cash flow, so they burn 80 million in the 6 months. That's going to improve as they get volumes up. So they have a year to 2 years of cash if it takes a little longer than they'd like for the market to really receive this product. If the sales come in strong, they're going to do well. Now, the piece that is kind of the disconnect is, okay, I like this forecast. And let's look at the analysts that are making this forecast. You see there's 8 of them. If this forecast happens, this stock's going to really, really do well. Okay. This thing's going to take off. But the piece that is kind of the little voice in my head saying, what the heck's going on with this quarterly revenue, man? Why can't you show some type of linear growth versus, and they're just getting started, but you would think they'd do a little better than that from a linear growth perspective. This probably shows that maybe CVS bought a bunch of them, some big health product distributor. It's just, this is what's causing my concern. So how can we further qualify that forecast? Let's take a look at the analysts that are looking at this. All right, so you got this guy, Jason. He's got a strong buy on it, believes that it's a $40 stock. He updated it on September 4th. That's pretty recent. So this guy's a pharmaceutical biotech analyst. Okay. All right. That looks pretty good. Okay. All right. So let me try to model these guys in a valuation schedule here. I'm going to put them right next to United Therapeutics. That's a company that is in healthcare. Okay, so let's get cracking here. So this is ARS Pharmaceuticals. So these guys are small, tiny, just got going. Is the market going to accept them? Risk, risk, risk. Higher discount rate. I want a greater rate of return. So let's take a look at their forecast again. So this year to this year, not a lot of growth. And they're going to explode, according to analysts. So $242 million. And their gross margins were 76% in this year when they sold a lot of product. So I'm going to need a sheet of paper. So we got $220 million of revenue that is expected in 2026. We're going to look 12 months ahead. Okay. We don't look in the rear view mirror. We look forward. Now, if they're going to do 77% gross margins, that means that their gross profit on 220 is going to be, you know what? Why don't I do this? Let me write a couple of numbers and then we'll do this together on the sheet. Okay. So I think their baseline of their operating cost, we're going to note that. So here's their gross profit, selling and administrative. So 72 million. Okay. All right. Okay, so we've got 220 million of revenue. Let me go revenue here, 220. Gross profit. And then their operating expense. And the baseline was like 72 million is what they spent last year. Okay. So all right. So we're going to take this expected revenue. I'm sorry. We're going to take this expected gross profit minus the OPEX. And that number is 97. Geez, my formats were kind of crazy there. Okay. So free cash is going to be 97 million going forward. All right. Let's go back to that forecast. Now, why am I putting so much thought into this, right? Whenever I look at a company, if I see that there is potential of a very good investment, I'm willing to invest more time. Now, this stock was like, man, data wasn't looking great. But once these analysts started saying, well, this thing's going to grow and it's going to be a $500 million business in 3 years, I'm like, whoa, hold on a second. If this happens, this is going to really do well. This could be like a 300% return on this stock. So that is what is compelling me to do more research. Okay. That's why I'm digging in deep on this one. Okay. So that's why we're going that deep. So let's look at this forecast. So I just forecasted here and kind of did a rough cut. They'll do $77 million of free cash here. Then they're supposed to grow at 67 and then 28. So they're going to basically go up 67, 28. Okay. All right. Okay. Back to the forecast. So we're forecasting free cash 97. Now, all right. So I'm going to go with the 97 and I'm going to only take 75% of that because I'm investing my money, my hard-earned money. I want to be conservative. If I'm wrong to the upside and I make more money than I expected, got no problem. But I don't want to be like, you're overly optimistic and now you're losing money, buddy. Like, no, I don't want that. I'd rather be surprised to the upside. Okay. So I'm growing cash here in year 2, 3, 4 by 40%. This is my number. And is this making sense? Yeah. So this is my number that I expect from this moment forward 12 months. This is the number for months 13 through 24, 25 through 36, and so forth. And then the terminal value is going to be nice and prosperous because it is a big addressable market. I'm good with that. All right. So what was our cash from? These guys had a good amount of cash. So we've got 240 of cash, 73 of debt. And the shares outstanding. How many shares do we have outstanding for ARS? 98.83. All right. 69% discount. Looks pretty good, Brandon. And I know your background, so you don't have to put it in the chat, but I would want you to email me and I'd want you to tell me what your comfort level is with this business. And it doesn't have to be like a big answer. It could be, no, I think you're optimistic this is going to work, or you're concerned. You're like, I don't get it because I see 3 or 5 problems, right? Love to hear that from you. Because the numbers are pretty show opportunity. If we get this one right, I think this thing could be like United Therapeutics, which I compared them to. So these businesses, right, they come out with there's diseases, illnesses, conditions, and one of these great companies with great scientists come out with a treatment for, in this case, United Therapeutics does rare diseases. So they come out of the treatment, and some people get to live a longer life. They get to live a better quality of life. All those great things. And if you would have bought shares in these guys, you would have close to quadrupled your money. Okay, so what we're looking at here, okay, is potentially a company that's like over here. So United Therapeutics is like this. Catalyst Pharma. I mean, you could see these companies. This is what happens. If we get the right ones, we get to go on this ride. This is like going to Disneyland and they close the park and all the rides are on and you get no lines into the park. You can go on all the roller coasters, all the coolest rides with no line. That's how fun it is. So that's why I was so interested in it. So let's go back to this guy. Now, when we look at the forecast one more time, so they're not going to make money until 2027, which isn't too far away, right? And I'm cool with them not making money. It's not like a big deal. I'm more concerned about cash. And this top line revenue, this is really exciting. So I'm cool with that. That's fine. We're going to leave that off. So that's my valuation on Spray or ARS Pharmaceuticals in San Diego. That's a hotbed for biotech, pharmaceutical. University of California, San Diego has a very good school where they do biology, life sciences. A lot of people, get educated down there, and they just have a big community of smart people in this field. So this one here, that's one that I'm gonna have to. I would say that's the coolest one I've seen today, and that one's gonna take my attention. I'm probably gonna think about having a little starter position in these guys and really watch their next earnings, like analyze it, from start to finish. Because if they start growing, this stock's going to explode, man. If they don't grow, opposite. It's going to be like, why aren't you growing? What are you doing wrong? Is the market not liking your product? Do people not believe you? There's just a lot of questions there. Now the stock, man, geez. Holy smokes. Market did not like something. They announced on the 13th. So yeah, so those numbers, I'm not the only one that's looking at these numbers going, guys, what's going on here? Like, you had an awesome quarter, Q4. All right, Q1, you laid an egg. Okay, I won't be upset about that one because you had such a good quarter here. Maybe you oversold a quarter and left nothing in the pipeline to sell. But then one more quarter that's like, not getting it done, and that's why it's sold off. If they come back and put like a 10, this stock's gonna suffer. But if they come back and show like a 50 or 100, this stock's gonna like literally double in like a month or two, because the market's just gonna like run over itself to try to buy the stock. Man, that was a good one. Man, I got my money's worth out of that one. Thank you for bringing it up. And we looked at this stock on a member call. Excuse me. And I think it was a morning call. I looked at it and I didn't focus on this forecast enough because I didn't see this. So I kind of need to publish a quick video to make sure that another member that brought this up gets my new analysis, because this is looking good. It looks interesting, I should say. This is going to be a high risk stock, But if it works, it's going to work quite well. So we'll see where it goes. All right. Neil Weston, what's up, man? I don't get your comment. Puerto Rico's is deleted from Earth. All right. Okay, so no more requests are out there. We covered a lot of ground today. We did I think a total of 5 valuations. How many did we do? 1, 2, 3, 4, 5, 6. Wow. We covered a lot of ground, everybody. You guys will be pros. If you want to get your hands on this model, like Brandon has access to this model. He doesn't even need me. He could just do this on his own if he wanted to. Just crank out the numbers. And then I shared this research with members as well. So not sure what this number is all about. So I'm going to delete that. All right. So in the chat, what do you guys think is going to happen next week trading wise? We've had the market's just been up and down. Some stocks sell off, some stocks rally. It's not a clear market of, is it going to go up or down? Any guesses on there on what's going to happen? All right. All right, guys. So we've been rolling for 2 hours. Man, that went by fast. So I think I'm going to shut it down at that point. Mission accomplished. I covered the stocks that were requests by members. And they email me or on Discord, they let me know. And I was able to handle those, which was good. Then I handled the ones that were requested. I really appreciate, was it Ben 10 provided the super chat, and we covered DraftKings. That was fun. And appreciate that very much. And Sebastian, you think a surprise 50 basis point cut? Man, that would be great. That'd be awesome. So we'll see. That is possible now. The jobs report showed that we had a little bit of a hiccup on job creation. So that might be the case. That might be exactly the case, huh? So as we end the stream, just for all the members, thank you so much for being members. I appreciate it. I think we've got really good numbers now, and we've got good collaboration on Discord, good collaboration on member calls. I really appreciate that. Anybody else, if you're thinking, you like the analysis you're seeing, you want to get better at analyzing companies, you want to have access to a Discord where we talk about stocks, take a look at the different levels of memberships that I've got for my channel. And you can go to the homepage of the YouTube channel, look for the join button, and you could see if one of these levels is right for you. You get more access, including if you're an advanced investor, you'll be able to access the tools like the model that I showed, or provide that. I provide access to my research. Just take a look at the level that would make sense for you. And again, thanks to all those who became members. So with that, everybody, enjoy your weekend. Enjoy the football games tomorrow. And we'll be back at it on Monday. Full week of trading. This past week, we had 4 days because Monday was a holiday. And I'm very happy with my performance this year. I'm having the best year of my investing career measured in dollars. My stock investing, it keeps getting better year after year. And I'm happy about that because it drives a lot of appreciation, wealth creation. And I love seeing investments compound. It's very, very fun, gratifying. And it's also very fun and gratifying to interact with investors and see how investors are investing, see if I could help and be helpful to enable them to become better investors. Usually people have some questions and people have really good ideas on stocks. Sometimes some stocks are not very good stocks, and we can kind of get to the bottom of those. So that is it for the stream, everybody. Good to see you, Kurt. Good to see you, Sebastian. Brandon, thanks for the question. Ben 10, thank you, sir. And Ben Peoples, thank you, sir. And I'll see you guys soon. I'll see if I could stream tomorrow night, maybe while I watch the evening football game. Maybe we'll do a little football and stocks just to get ready for Monday. All right, everybody. Have a good night. Take care.